very weak ever since this top edge has been put in. And when you look at that, you can see that there has been a fairly sizable sell-off. But I wanted to just go back to the concept of the selling still coming in the S&P just now, guys. I wanted to go back to that concept of the amount of hedging that was available. When you're looking at the S&P, one of the things that we're always looking at is how much hedging is in this market. Now, one of the things that happened, of course, was we actually moved basically the bracket from settlement to settlement. We moved through to that bottom settlement price. So when we went from settlement to settlement, you can see it basically went to settlement at the bottom edge here. You can see the structure was pretty strong in terms of those levels. But key thing when you're looking at the macro picture is how much hedging is available. This here was the problem. This here coming into this day here was a problem because, you know, during that drop here, there was an amount of hedging, but it wasn't that much, was there? There was a lot of hedging up here, hence the reason why we were able to recognize a very, very obvious buy coming in at that stage, because there's plenty of hedge up here. There is absolutely nowhere near enough hedge for that same bottom edge price. So that's a problem, isn't it? Because we've got the same bottom edge price, but we've got nowhere near the same amount of hedging during that period. So obviously when the people came in the open and they suddenly realized that we have a lack of hedging and they started to buy a lot of puts, that's what causes this move, doesn't it? That's what causes the market to start selling off aggressively until we reach a point where there's now enough hedging. You can see we've just taken out the prior swing high here. We realize that there's enough hedging now in place here that allows the buyers to start buying into this bottom edge now, and it pushes the price back up again. So the lack of hedging is what causes these types of drops. When you think about it, that's a perfectly reasonable explanation, because, you know, if you're fully hedged, you're not going to panic sell. If you know, that's just madness. Whereas when we look at a market that isn't fully hedged, and then the selling comes in, and then the puts start coming in to get it fully hedged, that attempt to fully hedge causes the market to drop initially, because nobody was hedged before in the gamma selling, which is the hedge by the dealers. They sell into a falling market, which accelerates the fall. Accelerates the fall. And that's why, for example, when we see a market that's got no hedging at all, when that market starts to drop because it's got no hedging, that's why you get these accelerations. That's why we get these accelerations. If you come into a top edge like this one, right, there's absolutely no hedging visible, is there? None at all. Because there's no hedging, as soon as that hedging comes in, the dealers go short stock on a downtick, and it accelerates the price of the equity fall until the gamma builds. When the gamma builds, obviously the buyers start accelerating into the bottom edge buy side, and the market recovers. It's a vicious circle of trade, isn't it? A vicious circle of hedging, which causes the event that they're trying to hedge against. But obviously they don't care because they're now hedged against it. They're now hedged against it. So that put call kicks in, causes the down move. But because it causes the down move, it's also the result of the gammas building to the bottom edge that allows the buyers to step into this move and recover back off the bottom edges. Now, the big advantage is that there has actually been an increase in hedging this time. And if there's an increase in hedging, obviously what that means is that the gammas are going to be solid enough for the hedgers to not panic sell at this time. And because there's not a panic sell button at the bottom edge at the present moment, then this is obviously a more sticky bottom edge market where we can start to see buyers stepping into low prices, where they'll start to buy back into these bottom edges. The more hedging that's available, the more gammas available for the long puts, and anybody that's got a long put, then obviously they're going to be taking those expensive options, and they're going to be buying stock against those expensive options. And if the stock starts to hold, they'll unwind their expensive options whilst they can still get a profit on them, or a small loss. And obviously if they unwind those options, what happens? Well, the dealers have to buy stock, don't they? If I previously buy, let me just diagram it because I know it's a little bit, for people that don't trade options, it gets a little bit kind of complicated at this point. Remember, you've got two groups of people here. You've got the dealer and you've got the commercial, which could be a pension fund or whatever. So what happens, of course, is that the commercial buys a long put option to hedge downside exposures, yeah? So we buy a long put option to hedge downside exposures. What's the dealer's response to that trade? The dealer's response to that trade is what? Well, the dealer must do something very, very simple. The dealer must short sell stock. Why must the dealer short sell stock? Because obviously they've got downside exposure now. So the dealer short sells stock, and what happens to the stock price? Well, the stock price obviously then drives down into that environment, doesn't it? As the stock price drives down, what happens next? The profit on the put option builds. The commercial buys more stock at lower prices. And obviously they're using the gamma to buy, because that's now effectively a zero risk trade for the commercial, right? So obviously once they start to buy stock at lower prices, what happens to the stock market? What happens to the markets themselves? The markets start to balance, right? Stocks start to balance out. When the stock starts to balance out, then reverse, what happens next? What's the next step? What's the next step? Well, the next step should be pretty obvious. They close their puts. They close their expensive puts. Yeah? If they close their expensive puts, that then goes back on the dealer's desk. The dealer now doesn't have any downside exposure. So what does the dealer have to do? The dealer has to unwind their short stock exposure, don't they? So they have to buy stock, and that enhances the upside move after that sticky level gets established, yeah? So we start seeing the dealer buying their stock back at lower prices. So if we were to work through that process, if you imagine just for a second that little process, so this is how it plays out here, for example. So we'll take this down a little bit, a little couple of time frames, just so that we can get a bit of an idea about this. So this is how it works here. So you can see that there's a surge in puts and then another surge in puts. So the dealers are now shorting the stock here. The dealers are shorting the stock here, yeah? Dealers shorting stock, dealers shorting stock through that process. Why would they not buy calls? The dealers are the dealers. They sell options. They make a two-way market, so the dealers aren't going to buy calls. The dealers are just going to unwind their position, right? They're just going to unwind their position because they're still just locking in their premiums. The stock traders aren't going to buy calls. The commercials aren't going to buy calls because they're actually still very, very, very expensive products to buy, aren't they? That's why they're getting rid of their puts, because they are still expensive. They still have elevated volatilities because the market's at a bottom edge. So the one thing you don't want to do is you don't want to buy call options because they're very, very, very expensive because of that implied volatility increase. So the best market to buy into at that stage is an outright stock position because it's got the best value because you don't pay for implied volatility, but you still get implied volatility in it, which is great news. So the dealers are selling this phase, right? The dealers are going short stock to hedge that exposure that comes in from this rally in the puts. So obviously when that rally in the puts finishes, the dealers obviously unwind their positions. Obviously they've now recognized the guys that are now buying the very, very low gammas in here. So they're now buying the very low gammas into these phases here. You know, they're using that put option, all of those put options to buy these low prints, and you can see it sticks. And obviously when it starts sticking, we can start to recognize the big break back into these areas where the dealers unwind their stock positions by buying all those stock positions back at exactly the same price, basically, leaving them with the exposure perhaps still to the puts because they maybe haven't unwound their puts at this stage. And obviously when they find that this is kicking off again here, the dealer obviously maybe has to come back in and sell back into it, at least temporarily. But there's obviously a lot of gamma still building into this now, isn't there? Because as soon as we hit these high levels, as soon as we start heading into these high levels, that's building gamma. So there's obviously the dealers have to go back short again into these stock moves here. But obviously the higher this goes, the better the opportunity for the guys to start using this to gamma scalp against. Now, obviously, when we look at that in relation to things like the volatilities and the specialists about what they're thinking about the markets and all that kind of stuff, it should start to make sense about what the specialists believe is happening. So as we drill down into the lower time frames, we start watching the specialists, whether they're bullish or bearish. We start watching for any ideas that this market's finished to the downside. We just pay attention to it from this point onwards to make sure we're actually getting a good read on the volatilities. And as far as I can see, that there is still a sizable drop off in the volatilities, which is suggestive of a big increase in index prices. And that's what's showing up just now on the charts here. You can see that the volatility rotation is still very bearish. And as a result, we should see a stock price that's a lot higher at the moment. So I am still a buyer of low prices just now, guys, in equities.